Welcome to Real Estate Talk. We're tackling your questions about real estate. Today's question is, what are tax benefits for homeowners?
This is one of my favorite topics. First off, we should say we're not accountants, so always consult with your accountant, your tax professional, tax advisor before you do anything. But we're going to talk about some of the 5 popular tax deductions homeowners should know about this year. And so all of the benefits only apply if you choose to itemize your tax deductions rather than taking the standard deduction, okay? So depending on your situation, a standard deduction may give you more savings, and so you just want to really consult with the experts about this, okay? What's the first deduction you want to cover, Joe?
The mortgage interest deduction.
Love
so
that
one of the
one.
biggest tax perks of owning a home, and you probably heard about this a little bit before when you are exploring home ownership, is the mortgage interest deduction, which means if you have a mortgage, you can deduct the interest that you paid throughout the year, which can, Courtney, amount sometimes to thousands of dollars in savings.
Oh, yeah.
You can deduct interest on up to $750,000 of mortgage debt, or $375,000 if you're married and filing separately. If your mortgage started before December 15th, 2017, good news, the limit's higher if you have that amount, where it's up to $1 million or $500,000 if you're filing separately. You can also claim a deduction for a second home, but as we stated earlier, you'll need to itemize the deduction to claim the deduction.
For sure. I want to talk about the second deduction, which is the property tax deduction. So another key tax break for homeowners is the state and local tax deduction. We're going to call it SALT, okay, which helps offset property taxes. But to claim it, you'll need to itemize your deductions, okay? You can deduct up to $10,000 if single or married filing jointly, okay? $5,000 if married and filing separately, okay? On what you spent in local and state taxes, okay? With SALT deduction, it applies to property taxes, income, and sales taxes. However, you can't deduct all 3. So you can choose to deduct property taxes, but need to choose between income and sales tax deductions. Option 1 is deduct property taxes plus state and local income taxes, okay? Option 2, deduct property taxes plus state and local sales taxes. So definitely contact your CPA on this one.
Same with this third one, Courtney, which is a little bit different. It's a mortgage credit certificate. So you're actually the one that flagged for me when we talked about this in prep that it's not exactly a tax deduction. It provides dollar for dollar tax credit to recipients to increase housing affordability. But it's still worth touching on because it's a possibility that you can use this where it's a special home buyer assistance program that helps offset interest costs. So basically, you can typically claim this every year as long as you meet the requirements for it. This means that it directly reduces the taxes that you pay, which is why we're bringing it up here. And you need to apply for the mortgage credit certificate that you at the time you buy the home. So it's not something you can claim after the fact.
The fourth deduction I want to talk about is the home office deduction. If you work from home, like Joe and I, you might qualify for this tax deduction, but there are a few things to know. Your home office has to be used for work only. It can't double as a guest room or a gym. This deduction mostly applies to self-employed workers, okay? W-2 employees usually don't qualify unless they're independent contractors. And there's really 2 ways to calculate it, okay? One option is the simplified method, which gives you $5 per square foot up to 300 square feet. Okay, so maximum deduction is $1,500. The other is the actual expense associated, where you deduct a portion of the rent, mortgage, interest, utilities, and maintenance based on the size of your workplace. You can also deduct work-related expenses like office supplies, internet, and a portion of your phone bill. But again, you have to talk to the tax pros about this to make sure you're not caught up in doing it properly.
All right, let's wrap it up with the last one, which is a home equity loan. So it's another tax break. And this is if you have a home equity loan, it's an interest deduction there, similar to what we talked about before. So if you've taken out a home equity loan, you might be able to deduct that interest as well, just like we were with mortgage interest deduction. But just like that, there are some limits. The limits are the same as mortgage interest deduction. So $750,000 if filing jointly, $375,000 if married filing separately, And again, if your loan was taken out after 2017, it only qualifies if used to buy, build, or improve your home. So if you used it for debt, medical bills, or investing, the interest is not deductible. So if you received a home equity loan before 2017, you can claim the deduction regardless of what you used it for, as long as the loan is secured by the home.
Dang, what was going on in 2017, Joe? They were just...
I know, 2017. What were we doing?
Selling homes.
Selling houses, for sure.
Exactly. So I've got some final thoughts. There are plenty of tax benefits that you may be eligible for as a homeowner, which we'll link an awesome article below in the description. It also includes some tips on what documents you'll need if you're filing your taxes as a new homeowner. We'll be back with another episode with some amazing tips to help you navigate the world of real estate, maximize these tax benefits, and just overall win. Let us know in the comments if you have any questions or if anything resonated with you today in this topic. And be sure to like and subscribe to our channel for lots of great content that's coming up that helps you get to your real estate goals. So thank you again for joining us. We'll see you next time.